Nice to see you all. Welcome to the webinar of today's evening, and thanks for tuning in. We're here at Digital Euro Association. My name is Manuel. I'm one of the co-founders of the Digital Euro Association, together with Professor Sandner, Alex Bechtel, Jonas Groß. And this today's webinar will focus on the digital euro evening. Let me quickly check because there is a feedback from the live stream. But Daniel, perfect, thank you. So today again, we will focus on the private sector digital euro. So not focusing directly on CBDCs. We have already touched this topic a couple of times, but more on private initiatives. And there's a lot of development actually in the field of stablecoins. We've seen some different types of stablecoins, centralized, decentralized stablecoins. We've already had a webinar on these stablecoins, on this enormously growing new type of money. And today we focus on bringing distributed ledger technology into the, let's say, regulated economy, as the regulation of stablecoins is still ongoing. And it is indeed questionable if many of these projects will actually we actually face today will provide an economically scalable solution and bring out the big advantages of distributed ledger technology. And this is exactly what we will hear about today by our guest, Tony McLaughlin from Citi Bank. So welcome, Tony. Thanks for your time and interest. And we will hear about the regulated liability network and how it can be used to create the regulated Internet of Value. So I find it very, very interesting and looking forward to your content and to your presentation. But before we dive into this, let me quickly share some minutes on the Digital Euro Association. So the Digital Euro Association is a think tank, and we founded it in the summer of 2020 with the idea that there should be a think tank about this new growing space of digital money, especially in the Eurozone. So focusing on CBDCs, stablecoins, other private initiatives. Our mission is actually to contribute to this whole space and to educate. And let me jump on the next slide, because these are the three pillars that we're focusing on. So education, community, and collaboration. Education, this is basically what we're doing tonight with this webinar. We build a community of experts and fellows in which we share all the information, but then also obviously discuss this whole new topic. And we collaborate in this field and help each other out to bring this new concept into reality. There's a couple of different ways how you can participate at the DEA. You can become a DEA fellow. So if you are interested in this whole topic and start to get, start to work on this in this field, you can become a DEA fellow, but you can also apply as a DEA expert if you are already an expert in this space and contribute to the discussion about this interesting topic. There's a QR code down there. You can scan that and apply. We also have a newsletter that is sent us quite frequently that will promote all these interesting topics. And we also have obviously participation possibilities for companies here. We're still looking for sponsors. We already have some, which I will thank on the next slide. But you can become an active member here, support the DEA, but also buy a stronger sponsoring there. So if you are interested in that, please let us know. You can also scan the QR code here on this slide on the right side, but make sure to reach out directly to us. And with that being said, I really want to thank the Bundesdruckerei and C-Labs, our sponsors here again, also for this event, and especially also Frankfurt School Blockchain Center of Philipp Sandner, who's also part of the founding group, right? So these are the contact details that we have. We're also live on Twitter and on LinkedIn. Make sure to follow us there. And now I don't want to waste any more time here and hand over to Tony here on this interesting event today. So Tony, just a quick notes on you. You started at ABN AMRO, switched to HBSC, then continued to your career at Citi Bank, where you now work in the field of emerging payments and business development. You're managing director there in the transaction banking space. So we're really much looking forward to your insights, and especially on your views on the regulated Internet of Value. And therefore, yeah, I would like to ask you now to share your screen. But yeah, last thing maybe, we also have a Q&A section at the end. And we have prepared a Slido here. Please scan the code or go scan the QR code or go to slido.com and insert this code. And there you can write the answers, the question, and then you can vote them up. The code should also be, or the link should also be in the YouTube channel there. So that's it from my side. Thanks for listening. And now I hand over to Tony.
Thank you very much indeed. Just making sure that my screen is sharing. Can you see the screen share yet or not? No, I don't think so, not yet. Let me just bring it up.
Now we
yes. Okay, fantastic. It's a real pleasure to talk to you today and share some ideas about how we might construct a digital euro. Slightly different conception than an instrument which is purely based on central bank liabilities. But before I get into the what we're proposing with the regulated liability network, I just want to get through a little bit of rationale of how we reached this conclusion. I'm not claiming that we have the right answer, but I hope that in my comments today, I give you a different model to contemplate as we think through what the future financial infrastructure may look like. So starting point is, I've been working in the payment space for the past 30 years. It's only really been cool for the past 5 years, probably thanks to crypto, probably thanks to Libra and CBDC. Everyone wants to speak about payments now, but I have to say, the news flow around payments, even for me, is kind of hard to parse. And finding the signal from the noise isn't easy. The gyrations in the Bitcoin price, the interest by big tech companies and others in terms of creating their own currencies, central banks interested in launching central bank digital currencies. It's all a really difficult environment to understand what's going on at a fundamental level. And frankly, there are people who are experts. Some of those people think that we're going through a tulip mania, and others think that something really deep is happening. So what I'd like to start off with is just by asking the question that if something deep is happening in the restructuring of financial services, what is that thing? And how that might inform, or how might that inform the design of a digital euro? So I'm going to present a very simple framework. I'm going to suggest to you that we're at a very interesting point in the history of money, where the kind of contest between digital money and physical money is in the end game. And that's only been accelerated by COVID and the rise of e-commerce. So, quite remarkably, our generation is the generation that might see the relative ending of physical money. And what we're in the beginning of is a contest between very, very different conceptions of digital money. And you might think of this as being a good old-fashioned format war. I remind you of previous format wars, VHS, Betamax, Research in Motion, Blockbuster, etc., etc. Format wars are very consequential for both the winners and the losers. And what I'm going to suggest to you is that we're now faced with a competition between 5 very, very different conceptions of digital money. Now, the American writer F. Scott Fitzgerald had this famous saying. He said that the sign of a first-rate intelligence is to be able to hold 2 opposing views in mind and still be able to function. Now, I'm going to ask you to try to hold 5 opposing views in mind and still be able to function, because we've got 5 fundamentally different conceptions about the future of digital money. So here's number 1, and I'll give you these, as if I'm a proponent of each of these different types of money. But number 1 is central bank money, and the argument here is that as cash dwindles, we cannot afford for the populace to only have access to private forms of money. A public form of money needs to be in place. And if physical central bank money is no longer available, then digital central bank money needs to be made available. By the way, central bank money has got great characteristics. It doesn't have counterparty risk. It can display the feature of finality of settlement. And if we launch a central bank digital currency, we'll be able to tackle issues from financial inclusion. We'll be able to, communicate monetary policy in new and interesting ways. We may be able to address deficiencies in cross-border payments. And actually, our currency will join this geopolitical contest between different currency blocks. We can't be left behind by others who will launch central bank digital currencies. So that's argument number 1, where central bank money in digital form at the moment is the privilege of banks like Citi Bank, of regulated financial institutions. But in the future, this type of money should be available to everyone. This is idea number 1. The second idea is that commercial bank money is getting better all the time. Huge investments are being made in the infrastructure to move around commercial bank money, which is, after all, a liability of a private financial institution. And those liabilities that we call money are one side of a balance sheet, and the other side of the balance sheet are risk assets. So the fact that most people transact in commercial bank liabilities, and commercial bank liabilities are 20 times the size of central bank liabilities, the fact that this is the dominant form of money on the planet, and we're making it better through improvements to SWIFT, improvements to open banking, instant payments, upgrading RTGS systems, everything that we're doing with commercial bank money is making it better. In fact, as commercial bank money goes 24/7, who needs these other innovations in the payment space? So idea number 2 is that commercial bank money will continue as the dominant form of digital money, and the rails supporting the movement of commercial bank money are getting better and better. The third opposing view is that electronic money, and we have the e-money directive in Europe, which has been tremendously successful in enabling regulated non-banks to join the digital payments market. This form of money is taking the world by storm. Think about the hundreds of millions of customers that PayPal have got. Paytm in India has hundreds of millions of customers. Several hundreds of millions of customers in China use Alipay and WeChat Pay. E-money as a model solves for the deficiencies of the commercial bank system. The commercial banks are slow, they're not agile, but we fintechs, our form of money is being adopted at pace around the world by consumers and merchants. Now, electronic money is obviously different to commercial bank money because it's essentially 100% collateralized by safeguarded funds. But the convenience and the form factor of electronic money really means that it really could be the dominant form of transacting medium of exchange in the future. The next conception of money is very different from the previous 3. This argument says that in the future, money should be separated from the nation state and the organs of the nation state. So Bitcoin, for example, is not a liability. In contrast to the previous 3 types of money, it's not a liability by design, because in Bitcoin, we're seeking a trustless world of money. And you can't build a trustless world of money based upon liabilities. So we're going to have a world of money without central banks, without intermediaries, and it will be exchanged on a peer-to-peer basis. It will be the native currency of the internet. It will prevent, because of the inbuilt supply limits, it will prevent any authority from debasing the currency, and it will just become the de facto type of money as the world becomes more digital. And finally, the stablecoin argument is, well, actually, Bitcoin and these other unbacked public cryptocurrencies will never make it as a medium of exchange because of their inherent volatility. And therefore, if we can have a type of cryptocurrency which has some of the characteristics of Bitcoin, but will maintain a stable value versus a fiat currency or a basket of other currencies or other assets, then crypto can become a medium of exchange. And again, it will be inherently digital, but it will cross the Rubicon from being a speculative asset into becoming a true medium of exchange. And so here we have it, 5 very different conceptions, 5 opposing conceptions for the future of digital money. We're at the very foothills of this race, and extraordinarily powerful players on the field. We've got the central banks, the commercial banks, the fintechs, the crypto community, which is attracting a huge amount of capital, the big techs, and those promoting stablecoins. Now, the question I would ask you is, what type of money do we want to have in the future? In the future, should our money be regulated or non-regulated? Clearly, central bank money, commercial bank money, and e-money are regulated. They're on the statute books. In a way, they're all the same because they're promised to pay the customer on demand at par value in national currency units. So the promise is always the same. But public cryptocurrencies and stablecoins, these instruments aren't so much regulated as the exchanges are regulated. So question number 1 is, do we believe that money belongs to the nation state? The first 3 fully accept that money belongs to the nation state. The last 2, not so much. The second fundamental question is, in the future, should money be a liability or a non-liability? The first 3 are clearly liabilities of regulated institutions. The second 2 are not. Bitcoin by design, and the stable coins. The biggest stable coin in the world is issued by an unregulated entity, sold to market makers who sell it to exchanges, who sell it to you. So if you hold that token in your hand, you have no claim on the issuer, no direct claim on the issuer. And the third question is, in the future, will money be tokens or accounts? And this is an intriguing one. At the moment, central bank money, commercial bank money, and e-money are almost exclusively available through accounts. Public cryptocurrencies and stablecoins are only available through tokens. And this is what I want to explore, that, what might be the benefit of tokenization of money going forward? And if tokenization is going to be decisive in the format war, what should the regulated sector do about it? So I just want to, pause here for a second and say something I think is an important mindset when we think about the value of DLT and the value of tokenization versus an account. For most of us in the regulated financial system, we deal with accounts because we're recording and moving liabilities. In the old days, we stored those liabilities on a paper ledger. Today, we store them on traditional databases. Both the paper ledgers and the traditional databases existed within our firms. Now, the question is, in the future, might we use DLT to store our liabilities? And what might change if we use DLT to store our liabilities? And I think this opens up some intriguing possibilities. But what we have to recognize is that whether I store, as an institution, I store my liabilities on a paper ledger, a traditional database, or a DLT, I haven't changed the legal instrument. If I store my liabilities on a stone tablet, I haven't changed the legal instrument. So what I'd like you to perhaps do is to separate 2 things. separate the legal instrument from the representation technology. But I think something interesting might happen if the regulated sector puts its liabilities onto DLT, because paper ledgers and traditional databases are within a firm. In DLT, it's a shared infrastructure. So can we create a network where the regulated sector records its liabilities in a shared network? And what might that mean? And what I think it might mean is something that we're putting into practice in a competition which has been won by the Monetary Authority of Singapore. They're running a global CBDC challenge. They had 300 entries, and we were lucky enough to be chosen as one of the 15 finalists. Winners will be announced on the 11th of November. And what we've proposed is this thing that we call the Regulated Liability Network. And it's a DLT that encompasses the liabilities of the regulated sector, meaning it has central bank liabilities and commercial bank liabilities and e-money liabilities on the same DLT. Remember, it doesn't matter where you write your liability. Your liability as a legal instrument survives different representation technologies. So we're saying to the regulated sector, write your liabilities into a shared DLT, and then interesting things may happen. So the way it works in the Regulated Liability Network is, in this case, you have the Monetary Authority of Singapore with a partition. And the way to think of a partition is like an embassy. You know, the French embassy in London is French territory, and the MES partition in the Regulated Liability Network is MES territory. Anything written into that partition is an MES liability, meaning it's essentially CBDC. Now, whether MES decides to only give that wallet to a financial institution, or it will maybe give a wallet to an e-money institution, or maybe to a corporate, or maybe to a retail customer, that's completely up to the participating central bank. But we've got this MES partition, which represents essentially central bank digital currencies. But the Regulated Liability Network is essentially CBDC++. We also have a separate partition for each commercial bank. So there's a Citi Bank partition. That's our territory. Anything that we write into that partition is our liability, as if we'd written it onto our own traditional database, as if we wrote it onto our own paper ledger. It's our liability. And there's a partition for each of the commercial banks who participate in the network. And there's also a partition for each of the e-money players. And their partition represents their liabilities. Now, the backing of that liability, the backing of Payoneer's liability or PayPal's liability in the network is different from the commercial bank's backing, but it still represents a promise to pay the customer on demand at par value in national currency units. So now we've got a DLT containing the liabilities of the central bank, the liabilities of the commercial banks, and the liabilities of the e-money institutions, the regulated sector. We've tokenized what we call regulated liabilities. And what we think is the significance of this is it's a way for the regulated financial sector to embrace tokenization in a joined up way. Because we don't want to see the regulated sector fragment. To us, the most important distinction in this digital money format war is regulated money versus unregulated money. And we don't want to see a situation where the regulated sector loses the technological arms race. So we don't believe in a world of bank coins where every bank creates its own coin. That would lead to massive fragmentation. And frankly, if we conceive of what we call narrow CBDC, which is CBDC only based on the liabilities of a central bank, every paper written on CBDC talks about its potential to substitute for the private regulated sector. So If what we're really about is pushing forward the entire regulated sector in a joined up way, does it make sense for CBDC to push forward the case of central bank money to the detriment of commercial bank money and e-money? Not if there's a better way, not if there's a joined up way for us to move forward together. So we are putting this into practice in the Monetary Authority of Singapore's CBDC proof of concept. We've built the network. We have a number of very important financial institutions, bank and non-bank, participating. The names that you see on the screen are only the initial members. We've now been joined by about a dozen other financial institutions who are very interested in this model. You know, what's the so what of this type of network? Well, any payment system that I've seen in my 30 years has been a messaging system, meaning there's no money in Visa or MasterCard or SWIFT or an instant payment scheme. The money is on the edges. The money is in the different institutions where they write their liabilities. The regulated liability network is different because the money is in the network. And that's, if you think about it, that's one of the core innovations of Bitcoin. The money is in the network. And when you have the money in the network, and that network is running 24/7, and that network has a programmability layer sitting on top through smart contracts, then the possibilities of moving around that money, using it for 24/7 settlement, become very interesting, especially if we do two things. Especially if we have multiple central bank partitions on the same network. And that's exactly what we want to achieve. So not just an MES partition, but an ECB partition, a Bank of England partition, a Fed partition. And then what you get is something very interesting. You get real central bank money from multiple central banks on the same DLT available for settlement. You essentially get a global RTGS system. And that's something that we've never had before. And the second thing is that, one of the intriguing aspects of DLT, if you think about it, it's less siloed than the traditional financial system. So Ethereum, for example, in Ethereum, you've got ETH, you've got stablecoins, you've got CryptoKitties, you've got NFTs. It's less siloed than our system because in a DLT, you can represent any arbitrary asset. And so we're also very intrigued by the notion of not only having regulated liabilities on this network, but also regulated assets on this network. And that moves towards this concept that we call the regulated Internet of Value. So I'll stop there and just leave you with this message, which is it's really important that the future of money is based upon the sovereign's right to decide what money is. All regulated institutions get their licenses from the nation state. The sovereign right to decide what money is comes from the social contract. It's one of the monopolies that we give to the nation state. It's extremely important that nation states hang on to that lever of national power. And so it's also beholden on the regulated sector, and I mean central banks and commercial banks and e-money institutions. In the future, stablecoins can be part of the same network. As soon as they're regulated as liabilities, they can join this network. It's extremely important that the regulated sector moves forward in a non-fragmented way. Otherwise, we may lose the arms race with shadow banking powered by DLT. So as we think about the design of digital euro, why not have a true public-private partnership? Why not have a digital euro, which is a network that encompasses central bank liabilities and commercial bank liabilities and e-money liabilities on the same chain? And I would just point out that what we're discussing here is not a million miles away from how Target works, because each of the national central banks project their liabilities onto a shared ledger in the target system. And therefore, why can't we just take that conception and extend it one or two steps further? So let's take the liabilities of the regulated sector, which currently exist in account-based form within institutions, and project them into a shared infrastructure, which might lead towards the next generation of financial market infrastructures. And with that, I will stop sharing and open up for questions.
Thank you very much, Tony. That was very, very insightful, especially also the last part about the MAS work that you are working on. I knew that you were part of the group that was accepted, and this now sounds very, very interesting to me. Also, congratulations that more than a dozen of financial institutions have now joined you. It sounds fantastic. It sounds very, very impressive, and also quite reasonable to me. And before I would like to start with some questions that I have provided, I would like to wrap things up a little bit and try to recap what you have said. These are basically the first two questions that I sent you in advance, but I think we already heard the answers to that one. So I can use them to reframe what you have actually said. So to me, actually, one of the most appealing facts of your article, and also the talk that you've just given, is the definition of money as regulated liabilities. So I think a lot of people still struggle to really understand and grasp what money actually is. And I think that's exactly what it is. So it is a liability of an issuing institution, and in this case, obviously regulated institutions here. And he also gave the comparison to cryptocurrencies such as bitcoins, but then also to stablecoins. And the money that we currently use are different types of liabilities. So either from the central bank, so that's physical cash or central bank reserves. We also have commercial bank money, which are liabilities of commercial banks, obviously, and e-money, which are liabilities of e-money institutions regulated by the e-money directive, especially here in Europe. All the forms of digital money that we have are account-based monies. So they are transferred by debiting and crediting one of the accounts, either of the sender or of the receiver, and I mean of the institution in which these accounts are held in the balance sheet. And with physical money, we have bearer instrument types of money. So cash, it is a bearer instrument. So that is, I think, one of the most important things to understand when we look at the current money that we have. Bitcoin, on the opposite, is not a liability. So it's a pure asset. You don't have a claim against an issuing institution on withdrawing some other asset or receiving some other asset. And that is very important as well to understand. It is also a bearer instrument. So and this is I think one of the great advantages that this new technology brings with it, because we now have a digital token. Let's say we only had physical tokens in the form of physical money, but now we have it digitally. And that is basically the current system that we have, the current money system. And then you also said that stable coins that we already see, those are, let's say, semi-regulated and do not really fulfill the requirements of the regulated liability network. So they cannot be added as of today, because a safe digital money that basically needs to be regulated, obviously, or from a regulated institution like we have it today with our current money system. It needs to be redeemable at par value on demand, and it needs to be denominated in national currency units. And it's always an ambiguous legal claim on the regulated issuer. That's what we define as e-money, actually. And in the regulated liability network, there should basically be CBDC, there should be e-money tokens, and there should be commercial bank money token. And that is basically the basis for my first question here. Because when we now look at the EU, I mean, we're here at the Digital Euro Association, and we obviously focus mostly on the EU here. And with the upcoming EU regulation for stablecoins and the MiCA regulation, would this new regulation actually help to create these regulated liabilities stable coins? So that's the first part. And then the second part, actually, can commercial banks also operate under the MiCA and tokenize their liabilities? Or is there another regulatory framework needed in order to, make the commercial bank money token reality?
Yeah, great questions, Manuel, and masterful summary as well. Thanks very much for playing that back in such a cogent way. First question on the stablecoin regulation. I think that we've got in Europe a very successful framework in the e-money directive. And if you do a side-by-side comparison between the requirements on an e-money issuer and the requirements on a stablecoin issuer, I can't see where those should differ. In fact, if we create a stablecoin regime, a bespoke stablecoin regime, which is what you might call e-money minus, then why wouldn't the whole e-money industry move on to that regime? So I think the regulatory arbitrage there is a potential threat. To me, the most vanilla way you could regulate stablecoins would be through a regime that looked very, very much like e-money. Again, I cannot think of a single requirement on an e-money player that shouldn't apply to a stablecoin issuer. So that's my point on stablecoin regulation. The second question about commercial banks, tokenization of commercial bank money. As long as we're not creating bearer instruments, which I don't think we should, I'm very wary about bearer instruments from a financial crime perspective. But I come back to my point, which is, Manuel, whether I write my liability to you on a stone tablet, a piece of papyrus, a traditional database, or a DLT, the legal instrument has not changed. And so I think it's very, very useful in this debate to be technologically neutral and say that the legal instrument is independent from its digital or physical representation. And therefore, I would argue that tokenized commercial bank liabilities are not a new legal instrument. It's a new form factor for an existing instrument, as long as we're not creating bearer instruments. And I don't think we should create bearer instruments when we tokenize commercial bank money.
And maybe coming back quickly on the MiCA regulation, because this is heavily debated and also expected quite soon to be going live, actually. And as far as I understand it correctly, the e-money directive is basically the center of the stablecoin regulation in the MiCA regulation. So if I understand you correctly, you would say, well, if the e-money directive is a good way to regulate stablecoins, we should be thankful for the politicians that came up with MiCA regulation, because this is actually the one of the best regulations that you could do for stablecoins.
And be thankful for the basis, which is the e-money directive. In the US, for example, there is no such national framework for e-money. And I think it provides Europe with a good baseline. I mean, at the end of the day, a regulated liability has the following characteristics. It's denominated in national currency units. It's redeemable at par value on demand. And there's a framework which means that the customer can be highly confident that when they redeem, they get their money back. And it also means that each and every one of the token holders needs to have an unambiguous legal claim on the issuer, which also means that the issuer needs to have a relationship, a legal relationship, a contractual relationship with each and every one of the token holders. So again, if you want to start out vanilla when it comes to thinking about how we might regulate stable coins, the e-money directive, I think, would be a good place to begin the thinking.
Great, yeah. Yeah, I mean, especially when we compare the EU with the United States, we see still a lot of debate how stablecoins should actually be regulated, and a lot of different regulatory institutions now argue which should be in charge of regulating stablecoins and so forth. So I also see that big advantage here in Europe. So coming to my next question, and maybe coming back to this new technology. So what do you think? What is so special about cryptocurrencies and maybe stable coins that we currently see? When it comes to the settlement of the transactions, right?
Yeah.
And can regulated liability tokens also reap these benefits if there are some benefits?
Yeah, and look, I've always thought that DLT is just another kind of database, and therefore we have to answer the so what question of DLT. But when I compare the traditional financial system to Ethereum, for example, I find that Ethereum is always on, but the traditional financial system is not. I find that Ethereum is inherently multi-asset, and the traditional financial system is inherently siloed. And I find that Ethereum is programmable and the traditional financial system is not. So I do think, going back to this idea from the Bitcoin white paper, which is an electronic coin is defined as being a chain of digital signatures. I do think in that you get this more generic way of representing financial instruments. It just so happens that what we've got to do to get the benefits without the downsides is we've got to recognize that Bitcoin is a non-liability. And so if you could rewrite the Bitcoin white paper and do away with a part of the ideology, the part of the ideology which doesn't work for nation states is where it says, let's get rid of the connection between nation states and money. So if you go back to the kind of first principles and say, well, actually, is there a technology which improves the financial system by recording financial instruments as chains of digital signatures on shared ledgers? Then you get to a different place. But a project that says, let's sever the connection between money and the nation state, I don't think is going to get much support from the regulated sector.
And I mean, when we look at the settlement of cryptocurrencies and stablecoins, to me, it seems quite novel that you also have a token, just like physical cash, actually, that settles all the transactions that once they are done, right? So there's no need for any other asset to actually settle these transactions like we already have, or like we have in the current system, right?
In the regulated liability network, to make the liabilities fungible, there has to be a settlement layer. So, for example, if I'm in institution A and you're in institution B, then a payment works in the following way: that we burn a token in institution A's partition, we mint a token in institution B's partition, and we send a token from A to B in the central bank partition. And what that does, it means that because when you move liabilities from one institution to another, there has to be a matching asset transfer. Institution B will not accept a liability to Manuel without receiving a settlement. And so if you accept that system where we live in a world of different balance sheets and liabilities need to move from balance sheet to balance sheet, then the only way you can achieve that is by settling those obligations in central bank money. And that's why the involvement of central banks in the regulated liability network is essential, because that's the layer through which everyone else settles their obligations.
Yeah, so recapping, I mean, I also think that is a big problem of these regulated liabilities that are still kept in accounts, let's say, because they're not, as you said, they're not bearer instruments that can actually move from A to B, and that are not part of any balance sheet anymore, because they're still recorded as a liability of also the receiving institution then. And every holder of the token actually is the creditor of the institution that created this liability, right? So anytime these liabilities would be transferred, actually the claim against the institution would be deferred, let's say, because you wouldn't actually know, I mean, who I have to claim my money from, right?
That's exactly right. Which is, if we have a world of, again, individual bank coins, then the holders of those bank coins are going to have to be KYC customers of the bank, and it's going to be an interoperability challenge. Let's say if every bank does its own thing with bank coins, but again, narrow CBDCs. If you take the analysis that I mentioned before about, it's really a question of, some policymakers, the distinction they think is the most important is public money versus private money, and that is an important distinction. Don't get me wrong, but I think what is a more important distinction is regulated money versus non-regulated money, because there's always been shadow banking. When you take shadow banking and you combine it with today's technology, like DLT and public networks, you can scale shadow banking to an enormous degree. And that's the danger, which is if non-regulated money has a technological advantage over regulated money, we're going to see a shift in transactions from the regulated sector to the non-regulated sector. And therefore, it is, to my mind, an imperative for the regulated sector to respond and adopt this technology. But it must adopt the technology in a joined up way, because if we do it in a fragmented way, we will not mount an effective defense of the regulated sector versus the non-regulated sector.
Yeah. So you already mentioned that basically when these liabilities are transferred from A to B, and especially obviously across different institutions. So let's say Citi creates a tokenized liability and transfer it to me, and I'm customer of, let's say, Commerzbank or Deutsche Bank, or even to PayPal, because then we have also the e-money world in it, right? You mentioned, or you said, that these transactions need to be settled in central bank money, just like today, basically what we have at the core of our payment system. Could you maybe focus a bit on that part as well? Because to me, it's quite interesting how that can happen in an automated way. Yeah. Is it that you foresee an adapter that connects different DLTs with each other? Or where do you see the minting and burning of tokens and all this? So that would be very interesting.
Well, for the proof of concept that we've put together with our partner Settle, who is the blockchain provider, all of these partitions exist on the same DLT, and the burning of a token, the minting of a token, and the settlement are all orchestrated in a single atomic transaction. So it all happens or nothing happens, essentially, in a single DLT with a single, programming layer on top of it. So we're doing everything within a single DLT for the time being. If in the future it becomes a constellation of different interoperable DLTs, so be it. In a sense, RLN is a concept. And the purpose of RLN is to say, if we're going to have a digital euro, a digital dollar, a digital pound, is there a way of constructing it so that the regulated sector moves forward as one? Because frankly, I would say that where we are in the CBDC debate, it's pure Marxist dialectic. Libra is the thesis, CBDC is the antithesis. But I believe that there's a step beyond that, which is a synthesis where the regulated sector comes together to rise to the challenge of tokenization and adopt DLT technology and exploit the benefits of DLT in a responsible way. So to my mind, I know that many countries are already launching CBDCs or conceiving of CBDCs, but I just hope that the RLN concept gives people an alternative model for building a digital national currency, as a true public-private partnership. And just to make this very clear, it's not a Citi platform. It's nothing to do with anything proprietary. If the community ever builds an RLN, it will be done in a public-private partnership as a consortium. And we're not locking in any technology. The consortium will choose the technology. It will be an FMI, a financial market infrastructure. It will be run according to the PFMIs, the Principles for Financial Market Infrastructures. And the reason why it needs to be is because it's a settlement engine, and it needs to display finality of settlement. And it will need to be regulated by multiple regulators, maybe a bit like CLS, for example. So we think, and look, it's a very heavy lift to build the kind of infrastructure that we're suggesting. But so far, a number of commercial banks, non-bank players, central banks have taken interest in the model, and everyone who's watching this can participate. Again, it's completely non-proprietary. We're not building a Citi Bank platform. All we're doing is saying, maybe there's a better way to build digital euro, digital pound, digital dollar, based upon bringing the regulated sector together in DLT in a joined up way.
And then also to use this platform, obviously, to build the regulated internet of value. That was basically your last point, where you say that also tokenized assets should be issued on that network.
Look, we have silos, and every financial institution has silos. And what is a silo? A silo is a dedicated infrastructure for a given legal instrument. We've got silos within institutions. We've got silos across the financial industry. The history of technology is moving from the specific to the general. So you move from a specific adding device, like a specific calculator, and you replace that with a general computing device, a Turing machine. And what I find fascinating about the DLT technologies and the public blockchains is maybe they're showing us the way to have a less siloed financial infrastructure. Maybe we can have a general bean counting layer where green beans represent money and red beans represent equities and blue beans represent trade instruments. Maybe we can generalize that bean counting layer, and also maybe we can change the topology of the financial market infrastructure and put the instruments in the network, which I find to be the true insight of Bitcoin and Ethereum, is that the instruments are in the network. In our world, the instruments are at the edges of the network. And I really love Sun Microsystems used to say the computer is the network. Maybe in the future financial market infrastructure, the network will contain the liabilities and the assets. It will be always on. It will be multi-asset, and it will be programmable. So that's a big vision, but that's what we're scratching towards. We're inching towards in the work we're doing on the regulated liability network, and everyone is welcome to join.
And you already have also partners from the asset side, as I saw, right? So include tokenized assets in the pilots there, or in the
absolutely. Again, moving towards a less siloed financial infrastructure would seem to be one of the signals, one of the opportunities that the regulated sector can take from public blockchains. I just have to make this point, which is, in the whole history of regulated institutions trying to use DLT, we've been infected by what I call the cult of the use case. And so what you've got is someone saying, I've got a use case, can it run on DLT? The answer is yes, because the DLT is Turing complete. Anything you can run on your existing legacy infrastructure, you can run on DLT. So no need to test your use case. The answer is yes. Mm-hmm. The question is, what can DLT that traditional infrastructures can't do as easily. And again, I think the intriguing part of that is its multi-asset, always-on programmable nature. So rather than testing individual use cases where the answer is yes, we need to look beyond the confines of our existing infrastructure and see if there's a better way of constructing these vital national infrastructures, which have to be grounded. Again, the base of this is the sovereign right to decide what money is. And that's the hallmark of the regulated financial system.
Now, when I look at the debate in especially the financial sector, and when you look at commercial banks, there's a lot of debate still going on which DLT to use. And I mean, the governance part is also very important, obviously. If you use a public blockchain, you don't really have a possibility to change the governance there. You have to live with the network there is, right? So many institutions actually have looked to build some prototypes on private blockchains, especially Corda. Some used Hyperledger. So can you maybe share information on what you are envisioning for the regulated liability network and the Internet of Value?
Yeah, RLN is at the conceptual level, and therefore the technology is arbitrary. It can be any given technology, and the DLT technology will change over time and may take new forms. And maybe at some point in the future, the regulated sector will be able to publish their liabilities and their assets onto public infrastructures. How, in terms of future iterations, that's quite conceivable. We see the same thing in public cloud. Right at the moment, the regulated sector is on a journey towards cloud, but not fully there. And that may be a parallel to what happens, not only public cloud in terms of the servers, but public cloud in terms of the bean counting. Is it conceivable that there becomes a general bean counting layer for the world based upon a public blockchain? Sure, why not? But the RLN concept is independent of any given technology. It's really about saying to folks thinking through the next generation of national currencies, let's not get fixated on central bank liabilities. I understand why we're here. Don't get me wrong. The threat of a non-state central bank, that threat prompted the CBDC reaction to a large extent. So I understand why we're here, but I think there's time to pause and think about the best way of constructing the next generation of financial infrastructure. And I can't see how that a narrow CBDC is the ideal way forward. And I think the literature kind of points in that direction. It's very complicated to introduce a narrow CBDC, which is neither too big nor too small.
Before I come to my last question, I quickly want to also raise a question from the audience here. And there is a question, you touched on the effects of CBDCs on geopolitics as well. So which blocks do you think will form? That's the question.
Yeah, look, I think that the cross-border usage of CBDCs is super interesting. I also think that it's very amusing to believe that, in payments, again, I've been in payments for a long time, there are no silver bullets. And I can't imagine that there's one instrument which will solve financial inclusion and enhance monetary policy transmission and improve cross-border payments and address geopolitical considerations about the importance of my currency versus your currency. So I think that CBDC is suffering from an excessive weight of expectations. The other thing I think is very important is that countries have got territorial sovereignty and they've also got currency sovereignty. So if you are a country, for example, with capital controls, and another country launches a CBDC, which undermines your capital controls, you might get a little bit upset. So I think we're going to have some ground rules where countries respect each other's currency sovereignty as much as they respect each other's territorial sovereignty.
Great answer. So, Tony, we're already at 7 p.m. It went super quickly. As far as I'm concerned, I could continue another hour here. There's a lot of interesting insights getting from this project. I will follow it closely, and we also will follow it closely at the Digital Euro Association. Thanks a lot for your time and for your insights. It was very insightful. And yeah, I would wrap things up now. We have 7 p.m. sharp, and thank you very much for your attention and for
your pleasure. Thanks.
I think that should be it.